Okay, if you've glanced at the markets lately, you've probably seen a sea of red. It's been rough. So, what is really going on? What's the story behind one of the biggest sell-offs we've seen all year? Let's break it all down.
Because, those falling numbers, they're not just random noise. The stock market is trying to send a pretty clear signal right now.
But what is it actually trying to tell us? That's the million-dollar question, right? Is this just a little blip, something that'll blow over? Or is it a real warning sign of something bigger coming down the pike? We're going to get to the bottom of it.
Well, here's the thing. The answer isn't simple. It's not about just one single event. What we're seeing is actually two big stories, two major forces that are colliding at the exact same time.
So, just to set the stage here, we're talking about one of the worst days for stocks all year. A really, really steep drop. But here's where it gets interesting. While all that was happening, while stocks were plummeting, something else was quietly booming in the background.
And this right here tells you everything you need to know about the mood on Wall Street. Stocks go down and gold goes up. Why? Because investors were running for cover. They were flocking to a classic safe haven asset. Gold is where the money goes when people get scared. And that split, that divergence, it's a huge clue that fear is what's driving the bus right now. So what kicked off all this fear?
Okay, so the first big piece of the puzzle, the first major shock to the system, came from the world of international trade. It was just a crazy series of policy announcements that gave everyone, especially investors, a serious case of whiplash.
Just look at how fast this all happened. I mean, it's wild. Friday morning, the Supreme Court voids the old tariffs, and the market cheers. Everyone's happy. But then, by that same afternoon, bam, a new 10% global tariff is announced. And if that wasn't enough, by Saturday, it gets hiked up to 15%. I mean, talk about dizzying. No one knew which way was up.
And that brings us to a fundamental rule of the market. If there is one thing that the stock market hates more than bad news, it is uncertainty. And this was pure chaos. Nobody knew what was going on. Are these tariffs going to stick? Are they going to go even higher? What does this mean for everything? That confusion is exactly what sent investors scrambling for the exits.
And to make things even more complicated, this new plan wasn't even consistent. It basically created this messy map of winners and losers. You had countries like China, Brazil, and India that would actually benefit, while some of our closest allies in the UK and Europe would get hit harder. It just threw another wrench into the whole global economic machine. So that's the tariff turmoil, but believe it or not, that was only half the story. The second cause is a little more subtle, a little more existential, and it hits right at the heart of the tech industry, the very engine that's been driving the market for years.
Yeah, people are starting to ask a pretty wild question. Is AI getting too smart for its own good? It's kind of ironic, right? The same technology that everyone's been so hyped about, well, now it's starting to become a source of real anxiety.
So here's the fear in a nutshell. As AI gets more and more powerful, why would a business need to keep paying for a dozen different software subscriptions from giants like Microsoft or Salesforce? The worry is that if one super smart AI can do it all, it's going to eat the lunch of the very tech companies that created it. And you might be thinking, okay, but why does that one fear have such a massive ripple effect? Well, this chart explains it perfectly. Those top 7 tech stocks, the Magnificent Seven, they make up over a third of the entire S&P 500. So it's not an exaggeration to say that when those guys sneeze, the whole market gets a really, really bad cold.
But hang on, is this fear even logical? Bank of America actually called out a huge contradiction in the way the market is thinking about this, and they put it perfectly.
And this is what they call the AI paradox. Think about it. On one hand, the market is afraid that spending on AI is going to collapse. But on the other hand, it's also afraid that AI is going to get so powerful it replaces all other software. You can't have it both ways. For AI to get that powerful, companies would have to be spending more money on it, not less. It's like the market is panicking about two totally opposite things happening at once. Okay, so you've got tariff chaos over here and this weird AI paradox over there. But here's the key. These two big shocks didn't just happen in a vacuum. They landed square in the middle of a market that was already, let's just say, a little shaky to begin with.
What I mean by that is, the market was already looking pretty expensive compared to its own history. Stock prices were really high compared to the actual profits companies were making. It was like a Jenga tower that was already a bit wobbly. It just couldn't handle another piece being pulled out.
And there's a great way to measure this called the PE ratio. That's price to earnings. The easiest way to think about it is like a price tag for the stock market. It tells you exactly how much investors are willing to pay for every dollar of profit a company makes.
And as you can see here, that price tag has been getting pretty steep. Historically, the average PE ratio for the S&P 500 is about 18. Right now, it's sitting up there around 22. And when the market is that expensive, when valuations are stretched that thin, it doesn't take much bad news to trigger a big sell-off.
And that brings us right back to gold. Remember that? When investors look around and see a pricey, uncertain, and anxious market, they buy gold. It's like taking out an insurance policy. It's basically a bet that there's more pain on the way for stocks and maybe even the broader economy.
Okay, so we've got tariffs, we've got AI fears, we've got an expensive market. It sounds pretty bad, right? So what does this all mean for you? Well, if you're thinking long-term, this isn't necessarily a time to panic. It could actually be a time for opportunity.
And this is where we see the huge difference in mindset between a short-term trader and a long-term investor. A trader sees all this chaos and hits the panic button. But an investor sees a potential sale. They see a chance to buy into great companies at a cheaper price.
It really all boils down to that classic piece of wisdom from Warren Buffett, doesn't it? Be greedy when others are fearful. He knew that widespread panic in the market often creates the absolute best buying opportunities, but only for those who are patient enough to see past the noise.
So I'll just leave you with this question to chew on. The next time you see those scary headlines about the market plunging and everyone panicking, what's your first gut reaction? Do you immediately see all the risk, or does a little part of you start to see the opportunity? How you answer that, well, that says a whole lot about your journey as an investor.